How to optimize algorithmic trading for sustainable investing. In today's financial landscape, the intersection of algorithmic trading and sustainable investing is becoming increasingly important. Investors are not just looking for financial returns. They also want to ensure their investments contribute positively to the environment and society. However, optimizing algorithmic trading for sustainable investing can be complex. This blog will provide actionable insights on how to integrate sustainability into your trading algorithm, addressing key challenges and offering practical solutions. Introduction. As the world faces pressing environmental and social issues, the demand for sustainable investing has surged. Investors want to ensure their portfolios are not only profitable but also contribute to a better world. However, integrating sustainability into algorithmic trading presents unique challenges. How do you screen for sustainability? How can you align your investments with green trends? And how do you stay ahead of regulatory changes? This video will address these questions, offering a clear roadmap to optimize your algorithmic trading for sustainable investing. By incorporating sustainability criteria into your stock selection process, aligning with companies that contribute to environmental sustainability, and staying updated on regulatory changes, you can create a strategy that is both profitable and responsible. 1. Screen for sustainability. Incorporating sustainability criteria into your stock selection process is the first crucial step. By doing this, you ensure that the companies you invest in meet specific environmental, social, and governance (ESG) standards. Example 1. ESG rating integration. One effective method is to integrate ESG ratings into your algorithm. ESG ratings evaluate a company's environmental impact, social responsibility, and governance practices. By setting thresholds for acceptable ESG scores, your algorithm can filter out companies that do not meet these standards. For instance, you could exclude companies with low environmental scores or those involved in significant controversies. Consider a scenario where your algorithm is set to exclude companies with an environmental score below a certain threshold. This ensures that companies with poor environmental practices, such as high carbon emissions or involvement in deforestation, are automatically filtered out. This approach not only aligns your investments with sustainability goals but also reduces the risk associated with companies that might face future regulatory or reputational challenges. Example 2. Sustainability data providers. Another approach is to use data from sustainability-focused providers. Companies like MSCI and Sustainalytics offer detailed ESG data and analytics. By incorporating this data into your algorithm, you can ensure your trading decisions are based on comprehensive and up-to-date sustainability information. This allows for more nuanced decision-making that goes beyond simple exclusion criteria. For example, MSCI provides in-depth analysis on various sustainability metrics, such as carbon footprint, water usage, and labor practices. By integrating this data, your algorithm can make more informed decisions. Suppose a company excels in reducing its carbon footprint and has strong labor practices. This information can weigh positively in your algorithm, prompting investment in such companies. 2. Align with green trends. Investing in companies that contribute to environmental sustainability is not only ethically sound but can also be financially rewarding. Identifying and aligning with green trends can help you tap into growing markets and technologies that are driving the green economy. Example 1. Renewable energy companies. One clear trend is the shift towards renewable energy. Investing in companies involved in solar, wind, and other renewable energy sources can be highly profitable. For example, integrating stock data from leading solar energy companies into your algorithm can help you capitalize on the growing demand for clean energy. Consider the rise of companies like First Solar and Vestas Wind Systems. These companies are at the forefront of renewable energy production, and their stocks have shown considerable growth as the world moves away from fossil fuels. By integrating data from such companies, your algorithm can identify and capitalize on these trends, potentially offering substantial returns. Example 2. Sustainable technologies. Another green trend is the rise of sustainable technologies, such as electric vehicles, EVs, and energy-efficient solutions. By focusing on companies that are at the forefront of these innovations, your algorithm can identify opportunities in a sector that is set for long-term growth. Tesla, for instance, has seen substantial stock performance due to its leadership in the EV market. Beyond electric vehicles, consider companies involved in energy-efficient technologies like smart grids or battery storage solutions. These technologies are crucial for a sustainable future and are receiving increasing attention and investment. Your algorithm can track the performance and news related to these companies, ensuring that you are investing in sectors with strong growth potential. 3. Monitor regulatory changes. Staying updated on evolving regulations in the sustainable investing space is critical. Regulatory changes can have significant impacts on your investments and trading strategies. Example 1. Carbon emission regulations. New regulations on carbon emissions can affect the viability and profitability of certain industries. By monitoring these changes, your algorithm can adjust its stock selections to avoid companies that may be negatively impacted. For example, tightening regulations on carbon emissions can make fossil fuel companies less attractive. Suppose there is an upcoming regulation that imposes stricter limits on carbon emissions. Your algorithm can be programmed to track news and updates related to this regulation. Companies heavily reliant on fossil fuels may face increased costs and regulatory pressures, making them less attractive investments. By staying ahead of these changes, your algorithm can shift focus to more sustainable industries, minimizing risk and aligning with regulatory trends. Example 2. Green tax incentives. Conversely, regulatory changes can also create new opportunities. Governments worldwide are offering tax incentives and subsidies for green projects and technologies. By staying informed about these incentives, your algorithm can identify companies that stand to benefit, thus positioning your portfolio to take advantage of favorable regulatory environments. For instance, the introduction of tax credits for renewable energy projects can boost the profitability of companies in this sector. Your algorithm can track announcements and legislative changes related to these incentives, identifying companies likely to benefit. Investing in companies that are poised to receive government support can enhance your portfolio's performance while contributing to environmental sustainability. Conclusion. Optimizing algorithmic trading for sustainable investing requires a strategic approach. By screening for sustainability, aligning with green trends, and monitoring regulatory changes, you can create a trading strategy that is both financially rewarding and socially responsible. This not only meets the growing demand for sustainable investments but also positions you to be a leader in the evolving financial landscape. Implementing these strategies will ensure that your investments contribute positively to the environment and society while also delivering strong financial returns. Start integrating these principles into your algorithmic trading today to be part of the solution for a sustainable future. Happy trading!